Now they got more disposable. Now they're going to go on Amazon and buy more stuff, and it's going to accelerate this problem, is it not?
The challenge is the rate of change. This is what the Fed tries to manage. And, there's a White House Economic Advisory Committee that's involved in trying to figure out what's going to happen here. Because the current estimate is it's going to take at least a year or probably a year to work through the current logjam in the global supply chains. And during that period of time, as Chamath points out, what's happening is the cost for goods is climbing because people have to charge more because there's limited inventory and people are bidding up the value of that inventory. As they do that, the businesses end up needing to get more labor, and so they have to pay more to hire people. As they pay more to hire people, those people end up demanding more, and the cycle can actually go the wrong direction where you have an inflationary spike that persists. How do you taper that inflation? It's not necessarily great for economic growth if you can't produce the stuff. And it can actually cause these runaway kind of effects in the dynamic system of supply and demand when you have these things clogging up the system for supply. So it is a real risk, and it is the biggest thing that the White House, this economic task force, is kind of trying to figure out right now is where's the balance lie where you can basically try and taper this inflationary effect that's being caused by this logjam in the supply chain without causing economic disruption by raising interest rates. And so it's a really kind of complicated, second and third derivative formula that needs to kind of be resolved. And that's why so many of these little elements are so important to get right.
By the way, central bankers around the world have raised rates. The only place that hasn't gone up is Europe, ECB, and the United States, the Federal Reserve. So, and let's be honest, Europe and the United States, we absorb labor and materials from all around the world, right? We are the net importers. We are the net ultimate buyers of last resort of all of these things. And so if you're seeing inflation in those other, supply-driven economies, they are going to come on shore. They're going to hit us in the face. I think prices are going up.
The other free market argument that could be made is that these current trends will accelerate a trend towards more automation of low-cost labor. Because it now will make sense for businesses to invest in the capital, in the CapEx, in the infrastructure, and ultimately for technology companies to build that tooling to support that infrastructure that will automate jobs like working in fast food, like doing local delivery, like doing factory assembly, like moving things across the country in trucks. So self-driving trucks, factory automation, biomanufacturing, additive and 3D manufacturing, and 3D printing. These are all industries that could benefit from the fact that labor now for kind of, traditionally low income work has gotten so expensive that it starts to make sense to switch to the technology alternative, which historically may have been too expensive, but now starts to make economic sense to businesses. So there's a number of these automation industries that may significantly benefit, and that ends up ultimately being deflationary and the market comes into balance. So that's another way to kind of think about the macro on what may play out here.
There's a bigger risk here than just inflation. I mean, there's also a risk of stagnation or stagflation, because it's not just that prices are going up and workers' wages are going up, which could be a good thing, but the goods and services just aren't being produced. So, I mean, I know, like my own experience, I recently ordered a Tesla. When I got a Tesla a couple of years ago, like I got it in 2 weeks. It was like almost instant. This time, they wanted me to wait 2 months. I just got an alert that it's going to take 2 more months beyond that. So we have no idea. And if Tesla doesn't get most of the money, I don't think, until I actually take delivery of the car, right? That's when you make final payment. So now they can't book that revenue and those earnings. And Tesla isn't even the car company that's most affected by this. The big, traditional American auto companies like Ford are even more affected. So if companies cannot deliver their products, that can cause an economic recession. And I think like these are major storm clouds looming on the horizon. Now, what is the cause of this? I mean, I think it's multifactorial. A lot of the things that Chamath said. I just want to really highlight this port issue. There was a great tweet storm by Zach Cantor earlier in the week where he said the supply chain crisis is a clever rebrand. It makes it seem like there are grand exogenous forces at work rather than the unions holding ports for ransom while dozens of ships pile up, working just 2 shifts with a 2-hour break in between, the country at their mercy. And he goes on to elaborate on that. And that is why, I mean, to Chamath's point,
they're allowed to do that.
But to Chamath's point, this is why Biden felt the need to get involved. So the problem is, if you read the fine print on this story of Biden announcing that the ports of LA and Long Beach will open 24 hours, which they clearly need to get the goods to market. If you read the bottom part of the story, everyone's announcing their intention to go 24/7, but there is no date certain for when that's going to be. It's a negotiation with the unions. So, Chamath, to your point, they are going to have to negotiate with the unions. Initially it looked like the story was that Biden was going to use his sway, his clout with the unions to basically push them to take a deal, but I don't think he's really done that. Everyone's just announcing their intention to negotiate. Well, if the ports are holding the whole country hostage like this, that could cause a recession. I think that's going to rebound very badly on Biden.
Wait, hold on a second.
I think they're running 24/7 now, aren't they, Sacks? Long Beach and LA are both running 24/7.
Well, I just posted this article that came out, yesterday, and it says it was published 2 days ago, and it said there was not a date certain for when this. Oh, it's updated October 14th, which is yesterday. And if you read the bottom of the article, it says they have not determined a date for when 24/7 operations will start. They've just merely announced their intention.
Oh yeah, I'm just
to go 24/7.
So the Biden administration says it's not really they announced it as if it was a done.
Look, unless Biden is willing to listen, Chamath, you're right that they're entitled to negotiate, but here's the thing. They're holding the whole country hostage now. They're holding the economy hostage. So at a certain point, if their demands are unreasonable, it's I think proper for the president of the United States to step in and say, guys, this is ridiculous. You have to go back to work. We're going to help negotiate a deal here. That's what Reagan did with the air traffic controllers. The air traffic controllers union shut down the whole commercial aviation system. Reagan got involved, said you cannot shut down the economy this way. You must go back to work. Yes, exactly. So I think Biden is probably going to have to get tougher here.
Not that these longshoremen or the ports, I guess they're not striking. They're just not doing an extra shift. But he could do an executive order.
If they're doing 2 shifts, 2 hours a day, that's like withholding. That's like a partial strike.
Wait, they're doing 2 2-hour shifts or
that's
2
what Zach
8-hour
was saying.
8-hour shifts. They can't be doing 2-hour shifts. That doesn't make sense. Why would anybody go to work for 2 hours?
Read what Zach Hanner posted. He said that they're working just 2 shifts with a 2-hour break in between.
Okay, but those might be 2 8-hour shifts with a 2-hour break in between is how I would read that.
No. He says, read the tweet here. He says, before any changes this coming week, the longshore routine at the ports involved 2 shifts, 8 a.m. to 4 p.m. and 6 p.m. to 3 a.m. An overnight shift of 5 hours is available, but is up to 50% more expensive and rarely used. So basically, you're talking about, it's an 8 to 4 p.m. shift with a 2-hour break, or 6 p.m. to 3 a.m. So basically, yes. So it is that's 6 hours. That's 2 6-hour shifts.
They should be running it like, Elon runs the Tesla factories when they're building, which is 24 hours a day, overlapping shifts. Just get it done. There has to be a sense of urgency here.
They're going to have to pay him some reasonable overtime, but they can't. The unions can't hold the whole country hostage. And look, unless Biden steps in to solve this, we will have a recession. So it will.
Oh, so we do think that this could be a recession.
I think it's bigger than just the ports. I don't think reopening the ports is the entirety of it. I think there's a lot of other things going on. Jake, to a point you've made, we had 4 million people drop out of the labor force last month. That was unbelievable. So yeah, the unemployment rate looks great, but the number of people actually going to work is significantly lower. That was a huge shock to all the economists, seeing that many people drop out. There's still too many people who essentially are being paid not to work in one form or another, and that is hurting the economy. You also have this issue in China, which is very interesting. This was, I think, covered in the New York Times about how dependent Chinese factories are on coal. And which, is a bad thing. Obviously, that's not a clean energy source. But because of restrictions on coal, it's actually started to impact manufacturing over there. We can debate whether that's a good thing or bad thing, but it's contributing to the effect. I suspect that China has woken up to this, and they're not going to shut down their economy because of concerns about clean energy. So I assume this is a very temporary decision. And then, of course, you have the whole issue of COVID restrictions. There were a lot of international COVID restrictions. It wasn't just in the U.S. where they were shutting down factories or creating, a lot of rules that got in the way of keeping factories open. They were doing this internationally, and there's a lot of regulations around seafaring as well because of COVID restrictions. So you have this pileup, I would say, of regulations. Ultimately, I'd say with COVID as the origin, that have now caused this supply chain crisis. And unless it gets fixed, it could absolutely cause a 1970s-style stagflation type recession next year.
Chamath, do you buy that? Do you think we could have this combination of people refusing to go to work or just opting out and saying like, yeah, it's even if you pay me 35 or 40, I'm just not interested. I have enough NFTs and I don't want to go back to work.
I actually think that's exactly what it is. There was this really interesting tweet that I saw on Twitter. Hopefully, Nick, you can find it. But it was some kid that basically said, I'm growing up in Atlanta and there's a bunch of kids that I used to run with, who would otherwise be in the streets, right? Causing all kinds of trouble. And these kids are now at home, like speccing NFTs and posting on TikTok or whatever. It's just a completely different reimagination of like labor and time spent. And that's just a very small example. And so that maybe touches retail or maybe touches, quick service restaurants. But there's all these different things where now that at the end of this pandemic, people are making very different decisions about their time and how to spend their money. And again, I'll tell you again, there's a lot of people. You got to remember how many people in the United States have died or are dealing now with some reasonably important health issues at the back end of coronavirus. 500,000 people, 1 million people. I want you to keep in mind what I told you guys before. There is $70 trillion that has to get transferred down from all these baby boomers down to these people in their 20s, 30s, and 40s. And don't think for a second that they're not making different optimization decisions around perceived wealth. So I just think inflation is here. I think the labor shortage is going to get worse, not better. I think we're going to have to pay people more to get out of it. I think prices are going up. Input costs are going up. Energy costs are going up. So this is it. And
I mean,
I think that probably the Fed and the ECB are really raising. This time next year, they're probably in a really, really tighter posture.
What do you think, Friedberg?
We should also remember that there are going to be some responses from...
Sorry, Friedberg, last thing. Tech stocks in the fucking toilet.
Why?
Because
no bueno
of
for
multiples?
Tech stocks. No bueno for no cash flow growth stocks. Bleh.
Yeah.
In rising rate
everyone's going to start buying yield when...
Yucky poops. Nobody wants it. Yeah. Yucky poops.
Well, wait, let's explain this to the audience. Why, Friedberg? Why are you agreeing with Chamath?
I mean, once interest rates go up, you'll see that dividend yields will go up, which means stock prices go down because people will expect a higher return. Because if I can buy treasury bonds and make a few points of return on my money, and I'm going to have to buy a stock, I'm going to demand a few more points of dividend yield on that stock. So the price the price for stocks will typically go down to match the yield that you're going to get from these more risk-free investments.
No. To be more precise. A stock is either a promissory note about cash today or effectively a promissory note about cash in the future. The thing with tech stocks is we tell everybody the same thing. Your money is going to come 30 years from now because we're going to be a monopoly by then. And every dollar that I have today, I'm going to reinvest into R&D and engineering. And in an environment where interest rates are zero, you're happy to do it because you're like, well, great. These guys are investing at way better rates than zero, which is what I get from my bank. And so I want Facebook and Google and Amazon and all these startups to be putting all this money in the ground on my behalf. But when interest rates start going up, they say, no, hold on a second. I need more money up front, less money in the future because the future becomes more uncertain. And that's the big trade-off for tech companies where they get really pummeled.
Okay, well, is there a number in terms of the interest rate?
There's a class of tech companies, right? Like like Microsoft, Oracle, Google, where you are actually seeing an Apple, you're getting dividends and you're getting share buybacks, where the cash is coming out of the business. And those are the mature businesses that also still happen to have growth attached to them. And I don't see how portfolios are going to shed those assets. You're going to shed the more speculative, hey, we're not yet at a point of maturity. We're still
Peloton,
20, 30 years out. Whatever, yeah. The guys that are investing and there's no kind of line of sight to true cash flow coming back to the shareholders. But look, at the end of the day, the point I was trying to make earlier was that there is going to be a response, right? So we've seen, remember when the pandemic kind of set in and everyone started ordering from home, Amazon rushed out and hired 100,000 local delivery drivers. They bought all these trucks and they built their own supply chain infrastructure for last mile delivery to get products to people's homes. And we're now seeing on the other side, Walmart, Home Depot, Target, and other big retailers integrating their supply chain to get product into stores. And so they're starting to buy trucks, hire people, pay them significant, wages to be drivers on staff for them, rather than contracting to these third parties that are saying, oh, we don't have any inventory, we don't have any trucks, we don't have any drivers, we can't do anything for you now. And so the response is, think about it. You're a product company. You're Tesla. Tesla just went out and did this massive deal in Caledonia to source, some mineral that they need to make batteries or to make their cars. I can't remember exactly what it was.
Nickel,
but you're increasingly going to see the businesses that have a balance sheet step up and actually start to integrate their supply chains rather than have
full
this
stack, more resilient.
This disparate set of service providers, each of which is all typically operating at max capacity, and then they can't kind of respond to these sorts of jolts to the system. And so we're going to see a lot of investment, I think, by businesses that make product or deliver product to the consumer as they try and integrate the supply chain problem themselves. And that may take some of the strain off the system and some of this inflationary risk out of the equation. We'll see over the next couple of quarters. But certainly in this last earnings report, I saw some statistic, a very large percentage of earnings reports spoke directly about supply chain disruption affecting the forecast for the business and the ability for the business to meet their forecast goals. And that's just hurting everyone.
Okay, so throw into
So they're going to have to do something about it if they're resourced to do it, right?
All right. So Sacks, though, there are some silver linings here. Companies become more resilient. They become more automated. They build full stack. They build their own factories. We're seeing, the Taiwanese semiconductor company is doing a $7 billion project to build a new factory in Japan, funded by the Japanese government. So we're seeing a lot of redundancy, and we're also seeing the middle class grow. If people are making $35 an hour, $40 an hour, and they're getting healthcare and they're starting to have overtime and other concessions being made, that builds the middle class. It sounds like we're solving some problems as well as, dealing with this, I guess what you call indigestion.
Absolutely. Listen, inflation is a good thing. I know people think it's a really bad, terrible thing. There are certain kinds of inflation that are really productive. We have had to find a way to fight the bad parts of technology. Technology is great. 9 out of 10 things, it's amazing. Efficiency, all these great characteristics that it gives you. But one crappy externality of technology is that it's deflationary. You can do more with less. And that's fundamentally not great for earnings. It's not great for labor participation. It's not great for all these things that people, are really upset about today. So
it's great for the individual company getting those gains.
I actually think it's kind of like it actually balances out the natural pace of technology, which is like you have the natural ability to just actually have cheaper, faster, better, this inherent efficiency that's building up on one side of the ledger. But then what's great is on the other side of the ledger, you actually have, labor being able to balance it out. And I think that that's a really good thing because they can demand more to do the rest of the work that's not covered by tech. And
so I think that's important. What are your thoughts about this expanding middle class? Isn't it a great thing that, people are saying, I'll stay home instead of making $12 an hour. It's an unfair wage. It's not a livable wage. And then all of these companies are saying, you know what? Okay. Well, they folded so quick, the big companies. They went to $18 to $35 an hour instantly. They always had the money to pay more. They just didn't need to.
Increasing wages in real terms is a good thing. I think you have to ask why the wages are going up. Is it going up because of increased productivity, which is a good thing, or is it going up because of inflation? If it's going up because of inflation, then the wage gains are somewhat illusory because all the products that consumers want to buy are also going up in price. All we've done is devalue the dollar. So we don't know yet whether these. Well, we do know that inflation is actually very high. We don't know exactly if these wage gains are permanent or just a function of that. But let's go back to this inflation point for a second. I think this is actually really important. We're at something like a 5.1% inflation rate. It's just about the highest since the late 70s, early 80s. Now we have this threat of a supply chain crisis. This is, this is potentially.
No, we have a supply chain crisis. It's not a threat.
So
if people can't sell cars.
Right. This is a recipe for stagflation 2.0. Now, I think there's an assumption that if inflation persists, the Fed will simply just fight it. They'll increase interest rates somewhat and they'll control it. But I actually think that the degrees of action that the Fed can take here might be more constrained than people think. I just want to flag. So one of the primary sources I use for the national debt is this website, fred.stlouisfed.org. It's a good website that has a lot of charts by a branch of the Fed. So they have this chart. We've seen that federal debt as a percentage of GDP is at sort of all-time peacetime highs. We're now we were at 100% for a few years, and now because of COVID, we just rocketed up over 120%. We're close to 140%. Now, the argument by mostly liberal economists that the debt didn't matter was because the debt service remained very low on this debt. So we had a huge increase in debt, but because interest rates were so low, the debt service was still very, very small. And I think, they have a good piece on this website about this as well that I'll just post here in the notes. But I don't know if you guys remember back to a pod we did in May where we talked about Stanley Druckenmiller came out swinging against the Fed, and he warned about this very situation. I want to just read this article that we covered back, I think in May. It feels like an eternity ago, but do you remember when we just talked about this? What Druckenmiller warned is that if yields on the 10-year Treasury rise to the projected level of 4.9%, which is simply the historical average, the government spending would be close to 30% of GDP each year, simply paying back interest expense compared to 2% last year, unless it monetizes the debt, which experts think is unlikely and Druckenmiller believes would have horrible implications for US dollar. So in other words, we now have this enormous debt. The only reason why debt service payments aren't crowding out the entire federal budget is because we've had interest rates at historically abnormal lows, zeros basically.
Yeah.
So how exactly is the Fed going to fight inflation? If they jack up interest rates to where they should be, say 4.9%, then the entire federal budget will be going to debt service.
They're actually working against themselves, right? It's like you're the bank and taking the loan at the same time. This is like somebody who gets a variable interest mortgage and they get 5-10 years into their mortgage, and then all of a sudden they go from interest only and some low interest rate, and then they have to pay market rate, and they realize they can't afford the home. We might not be able to afford the budget we're putting out there, is what you're saying, Sacks.
Well, I'm saying the Fed may not have the tools, all the tools they want to fight inflation if it comes back. Or, it's going to be politically very unpopular. Can you imagine the pressure the Fed will be under not to raise rates if it means that all of these discretionary programs basically have to be cut, that we have an austerity mode in the federal budget? How are we going to pay for all this debt service?
Yeah. And then the first thing they're going to think about is, hey, maybe we should cut military spending since it's the largest at the time when China is doing sorties in and around Taiwan and the South China Sea. And we've got, 6, navies doing coordinated sailing there, which I think is a adjacent issue here.
Historically, great powers that want to remain great don't owe over 100% of their economy, especially, when a lot of it's held by foreign powers. That is a situation that makes us fragile, not anti-fragile, right? Because if we hit a crisis, if there is, some unforeseen military conflict, what glass do we break now in case of emergency? We're in peacetime and we have wartime levels of debt. And now inflation is making a return, and the Fed is going to have to make some really tough choices about whether to control inflation and essentially impose austerity on government spending, or whether they monetize the debt, which will lead to a runaway depreciation of the dollar. Neither one of those things is a good situation.
How would the Fed impose austerity?
Well, they can't, but again, if debt service rises to 30% of the federal budget, where's that money going to come from?
You have to raise taxes and cut spending. You have to do both.
Which is why, and I think this is Joe Manchin's point. And, if you've been listening to Joe Manchin talk about the current reconciliation bill, and he says, look, 3.5 trillion doesn't make sense. We don't know what situation we're going to confront in the future. We don't know what crises are coming. We're going to reduce our ability to tackle all those future problems by overspending right now. That's been Joe Manchin's argument. And looking at this risk of stagflation in the forms of the supply chain shortage and this 5.1% interest rate number, you'd have to say that if we want to preserve any flexibility next year to raise interest rates, you better be really careful about how much debt you incur now.
Chamath? Agree? Disagree?
Yeah, look, when Druck said that, the 10-year break even was sort of, at a 5-year high at the time. We're back there now. Look, I'm just going to, I said this on CNBC. I'll just say it again. I think it's coming. I don't think it's a short-term blip. And I think that we are in a period that will resemble the late 70s. And I think that, you kind of want to be risk off and not own risk assets. And by the way, it is hard, okay? Because we are all of us, all 4 of us, we're both risk on, and all we own are risk assets that are, it's one thing to say, let's take risk, but you could take risk in lower of all things. This is like taking risk in the most risky thing. That's what we all do.
And at a time when people have run up the valuations of private market companies to a level that just nobody can understand.
I mean, look, I think you got a year to 18 months to kind of clean this stuff up, meaning like as market participants, we can shuck and jive and get everything into a decent place, but it's coming. And I hope I'm wrong, but I think we'll look back on this and we'll say we said it probably 8 to 12 months before it really reared its ugly head, but it's coming.